Good afternoon. It is October 30th of 2023. One day left in October. And this is Robert Rayburn here at Life Pro Asset Management. And we're pretty happy that October is coming to an end. While the first 3 weeks, I would say the first 2 or 3 weeks of October, we skated through pretty nicely while the rest of the stock market came down. The fourth week was really about the market returning back to those stocks that had not gotten hit yet. And sure enough, energy was right smack in the middle of that. And, despite last week's weakness in energy and despite the market's weakness over the last, really called the last 2.5 months, we are even more bullish on energy and commodities and a lot of these geostrategic assets that are going to just become more and more valuable as that multipolar geopolitical framework sets up across the world, right? So that great power competition, that is, in our opinion, going to be the narrative around investing over the next decade. Geostrategic assets that global powers need, but need to compete for against each other as that global free trade system continues to retreat. As China goes its own way, as the US goes its own way, Russia, European Union go their separate ways, there's going to be a competition for assets. And we want to own those assets. We want to hold them tightly. And we don't want to try and trade them around week to week, month to month. And, we've been consistent with that large overweight in energy. The stocks remain cheap. And we're going to go through why we love all of those assets in this week's update. But the title of this week's update is why on earth do stocks keep falling, right? And when we look, really, there's been nowhere to hide. I mean, the entire stock market has been weak really since late July. We were pretty strong here at Life Pro, call it July, August, September, first half of October, and then we kind of got caught up in the last leg lower here. But we want to sort of really address the issue at hand is why is the overall market so weak? So three things we're going to go through. Well, first of all, why is it that they're falling when the economic data has been pretty solid? Earnings data has been solid so far. So the three things to address this, stock market correction update, why we continue to avoid the top of the market, as weak as the market has been. Certainly, we've seen a lot of weakness from the likes of Apple and Google and Meta and those areas where a lot of people are hiding. And then lastly, what's impacting oil and cannabis stocks this week, right? Cannabis stocks in particular got taken to the woodshed. So we want to understand, has anything changed in the story or is it just short-term trading? So we'll go ahead and take a look at that. So S&P 500, why are we so weak right now? So, there's really four things. Fears over rising interest rates, that's been a consistent narrative since the spring. Stubborn inflation. Inflation, despite what you hear on TV, has not gone away. So when you hear 4% as this, like, wow, inflation's gone from 9 to 4. Remember, we got 4% inflation on top of the 10% inflation we had last year. So as much as prices went up last year, they're increasing another 4%. And the Federal Reserve chains this together and says that's still too high. So I think we need to be cognizant of that. Of course, we always have that recession fear. That's been, I feel like it's been the last 3 years we've been talking about recession fears, even though the data has been pretty good. And then, of course, the Middle East war. And I think that's part of when we look at why oil has been weak, oil's held in, and then we get these weak days and the energy stocks have not traded with oil. Because I think there's some thought out there that there is a geopolitical risk premium in the price of oil. And then as soon as this is resolved, oil will go down significantly. We're not there. Inventories remain near record lows. Demand remains high. And quite frankly, I don't think that this Middle East war situation is going to be resolved overnight either. A few other things here, relative highs, cash, gold, aerospace, and insurance. Like those have been the relative strength areas of the market over the last 2 or 3 weeks. Relative lows, small caps, high beta, semiconductors, internet, transports, biotech, and REITs. So you see that weakness is really broad-based and really at the end of the day, focus on those higher risk areas of the market. So putting this sell-off into perspective from a financial planning point of view, there's been 239 sell-offs of 5% plus since 1927. That's a lot. The median magnitude of all the 5% plus sell-offs, around 8.23%. The average magnitude, right? So when you incorporate those outliers, is around 11.83%. So right now, we're sitting around 10.4%. If we incorporate, this was as of Thursday, so sitting around 11.5% or so in terms of the total drawdown of the S&P 500. So not that surprising. And we think there's probably a little bit more downside left in the S&P. Is there enough downside though to where we would want to go into client portfolios, shift to cash, and then try to time the move back into stocks? No, I don't think so. And I think that's a big question that we get from a lot of clients is, well, if you think there's more downside, why don't you move to defense? Because I don't really know how long the weakness is going to last for. We're already sort of 2 months into this. I think we just want to be careful about trying to micro time the market. And we do have to leave 2022 into one bucket and not be influenced by that, because that's where we compound errors. So I think what we want to do is just be patient more than anything else. Where we are concerned and where we are avoiding and we are playing defense is avoiding the top of the market, the areas of the market where everyone's invested in and overweight, right? So if we think of NVIDIA, this is an example of the top 7 or the Magnificent 7, the FANG, whatever you want to call it, those 7 biggest stocks that dominate the S&P 500. NVIDIA's been breaking down. We think that there's a lot more downside to this stock. This stock, this group as a whole is up something like 70% or something in that nature year to date. So there's a lot more downside. People have piled into this as bond proxies, as defense, as basically their form of cash with returns. So all of these narratives we have to be careful with because they're still stocks and they still have risk. And we believe they're very, very, very expensive, right? So the way I would frame this is that Apple, Google, NVIDIA, Meta, Tesla, fantastic companies, right? There's nothing wrong with the companies, but the stocks are really, really, really expensive. There's a difference between those two. The other thing we'll say is that interest rates really haven't budged. We saw this tweet from Bill Ackman calling the top in the rates market. Rates plunged. People sold oil and value stocks and bought growth stocks for a couple of days, saying, oh, hey, interest rates have topped out because this guy said so. Well, let's back up a little bit here, okay? First of all, the 10-year yield is right back close to 5% after this move lower, and then went right back challenging the peak. That's a sign of a bull market in rates and a bear market in bond prices, right? Treasury bond prices, to be specific. The other reason is we've seen significant inflows into long-term treasuries. You can see here by these blue bars. Typically, if you're going to get toward the end of a bear market, in this case, an end bear market in bond prices, you would see these lines be the opposite direction and deeply red. That would be your contrarian call to the other side. So we're not really seeing that in the rates market. So our call remains 5.25%. We think that could go to 5.5% if past that. That remains our focus. So cannabis, the whiplash in these names is incredible. It's why we only own 2 or 3 of them. But we think it's one of the cheapest areas of the market. So, just doing a quick tour in terms of what's happened in this space. Dead money, dead money, dead money. We've been talking for many months. It would just take a spark to get these names going. And sure enough, the Health and Human Services Department recommends a rescheduling of cannabis from Schedule 1 to Schedule 3. This is the ETF, shoots from something like 480 all the way up to 9. Now, mind you, at 9, it's really, really cheap, these names, okay? But then the Senate committee approves safe banking legislation. Now, there's a downside here. Well, these 2 catalysts now are removed, right? And now to wait and see, because the rescheduling has to be formalized by the DEA, right? We think it will, but it takes time. And then after the Senate committee approved the safe banking legislation then moves to the Senate and the House. Well, what happened with the House? The Speaker of the House was removed. McCarthy was removed as Speaker. And then Johnson was elected as Speaker, who's somewhat seen as anti-cannabis. Now, the good news is we don't own these for safe banking. We own these for rescheduling, for the incredible amount of earnings that these companies are starting to generate, and the valuations are dirt cheap. And if you get that rescheduling, of course, you start to get interstate commerce. So yeah, what this does is sort of delays that legislative process for safe banking, but it doesn't delay the rescheduling if the DA approves it. And it doesn't delay interstate commerce or uplistings of certain stocks to the New York Stock Exchange. So again, it's a really frustrating area to be in because you have a good idea or high level of confidence where that value is. And you can see it just takes a minor spark for these things to double, right? This thing went from 490 something to 9 in a matter of a week. We think that same pent-up value is there at 563 or wherever it closed out on Friday. So that's what we really have to pay attention to. So bottom line here is our thesis on cannabis has not changed. HHS has recommended Schedule 3 for cannabis. The DA must review and finalize the HHS recommendation. If that happens, we think that's a gigantic catalyst for the space. The Senate must vote on safe banking. Will the House take it up, though? Right? I think that's, you can look at the speaker and say, well, on paper, this guy's never going to take it up. But there's a lot of deals that happen in Congress. So we'll have to look at that. And of course, lastly, the stocks are just dirt cheap. On energy, another big area of overweight for us, short term, the stock market correction finally caught up to energy stocks. And we saw that over the past week. Long term, nothing's changed. Oil prices are higher from where they were when we bought these stocks. They're making more money from where we bought these stocks. The average oil price on a 5-week running basis continues to rise. These companies are cash flow machines. So we believe the energy market, even from a technical chart basis, has some of the best long-term technical trends in the market. So we look here, almost 90% of energy stocks have a positive long-term trend. Momentum has tailed off here as we've got caught up in the overall stock market correction. But when you map this out, momentum versus trend, energy stands out as the one group with the best trends, best momentum. And that's one thing we want to keep focused on. Why are we bullish on energy? We're repeating this from last week, but I think it's important. Inventories keep dropping as supply dries up. Inventories this week, global inventories, came in at the lowest point. Right? I want you to remember that. There are basically, for operational purposes, inventories have largely dried up. Demand for oil continues to grow, and the major swing supplier is the Middle East. So yeah, geopolitical risk actually does matter. So if you get into a conflict with not Saudi Arabia, but Iran, and that conflict spills over into certain Shia factions within Iraq, and that affects the Kurdish oil fields, that matters because that's not a 1 week or 2 week phenomenon. And then the big reasons why we own the space: structural lack of long-term investment in the ground, right? As demand rises and we realize that all of this ESG stuff that the US and other Western economies have been focused on has led to this massive drying up of fossil fuel investment. As people continue to drive, and we're actually starting to see some signs that market share might be shifting back to combustion engines, not prepared for the structural lack of investment in energy. We need energy today. I don't know what'll happen in 2030, 2040, but I do know I'll still likely fuel my gas tank in 2024. So we need to pay attention to that. And of course, mergers and acquisitions continue to be huge. Energy long-term, we think we're, again, in the second inning of a structural long-term bull market. The last one lasted about a decade. We're in about year 2 of this right now. So we really like where energy is. Again, lack of investment, rising demand for energy. Valuations are dirt cheap. A lot of these stocks trade single point valuations relative to the S&P at 17 times, and great power competition for geostrategic assets. So summary, let's stay focused on the trends, ladies and gentlemen. S&P 500 does remain in correction mode. That's okay. It'll end at some point. The top of the market remains an area of very high risk. We would avoid that area. And energy and cannabis remain some of the cheaper and more attractive areas that we can identify right now. So that's what we got for you this week. 888-543-3776. Feel free to give your advisor a call, give us a call. We're happy to help. Talk to you soon. Bye.